7 reasons to raise cash. First, the long-term interest rates, as measured by the 10-year and 30-year Treasury rate, are headed up. Historically, those rates have approximated nominal GDP. Nominal GDP is running north of 7% currently. We would expect interest rates to head that direction. Even if interest rates on the long end got to 5%, the market probably would have a correction based on that. In addition to that, the Fed has stated that they are going to taper. Taper means that they're going to be buying less assets on their balance sheet, less long-term bonds. So there's going to be a big current buyer who's going to be buying less of these long-term buys. Less buyers mean prices generally go down, interest rates go up. That's going to contribute to the rise in the long-term interest rates. Third is the Fed is saying that they were going to raise short-term rates. Fed rates increases are going to be 2 to 4 times this year on the short end is current expectations. This will also be a negative for the market. These 3 items are interrelated. I'm going to do a full video on this, talking about the impact of those and their interrelation in a separate video. The 4th reason is the political gridlock. We did not get a Build Back Better bill passed. That is still being proposed and being trimmed down. Something probably will happen, but the fact that it didn't get passed and is not being implemented now is going to be less stimulus for the economy, lower GDP this year. The 5th item is the reemergence of China. China clearly has made moves on Hong Kong. They're making noise about Taiwan. That is a big political risk. And then we have the Russian NATO Ukraine situation, which is in the news currently. Quite frankly, it's not in the news as much as you would expect, or as I would expect, given the potential ramifications of that. But that is a potentially big negative. And then the 7th item is valuation. Valuations are near all-time highs, especially for some of the high-flying stocks. As I mentioned back on November 3rd, some stocks are clearly in a bubble. There's SPAC stocks. There's stocks that are basically giving away all their earnings and then some in employee-based stock compensation, so they're really not making any money. They're selling at 15 to 20 times revenues. These stocks are headed a lot lower. Some of the companies that aren't making any money, burning through their cash, some of those stocks are probably going to head to zero, as I pointed out on November 3rd. So that process has started. I think it will continue. As I advised then, make sure that you know what you own. Make sure you don't have any of these, truly bubble stocks in your portfolio. If you have them and they've already started to roll over, I would use those as tax losses today. They're probably going to continue to head down. Some of these things are going to be worthless. You need to have a firm grasp on what the value of each thing you own in your portfolio. If you don't have an idea of a valuation based on earnings and cash flow in a 3 to 5 year period, there is no value. And there's going to be potentially no bottom in the stock in the near term. You need to be very careful about what you own here. The other item I wanted to talk to you about is implementation. So with that, I would expect that there's a very real possibility as rates go up, especially on the long end, that we have a 20 to 30% correction in the S&P 500 and a potentially 30 to 50% correction on the NASDAQ from the highs. I think that process seems to be starting, and depending on how fast the Fed tapers, we shall see how fast rates go up. And as rates go up, generally the stock market will go down, and some of these bubble stocks are really going to get clipped pretty hard. From an implementation standpoint, what I have done with my own portfolio is stocks that I have small gains. In my taxable portfolio, stocks that have small gains or losses, I have used that to raise cash in my taxable portfolio, and in my non-taxable portfolio, I have trimmed my big winners where there's going to be no tax consequences. I have also used the opportunity to go ahead and sell or liquidate companies that have fundamental issues that have not worked out as I expected. A couple of companies that I basically have almost round tripped on are Alibaba and Baidu, the rhetoric coming out of China, the VI structure, the variable interest entity, makes these companies more dangerous than I originally anticipated. Although I did make money for a while, I basically have given all that back in the past year. So I've gone ahead and exited those as the risk level has gotten much higher than I originally anticipated. I made a mistake owning those stocks. I may at some point re-enter those if the political rhetoric actually calms down in China, but I don't envision doing so at the time. The other two have to do with biotech companies. Biogen, which did get approval for its Alzheimer's drug, but the efficacy of the drug seems to be in doubt, so the payment mechanisms don't seem to be getting put in place. And although I did trade out a part of the position, on the announcement that the FDA had approved it, I'm going ahead and liquidating the rest of the position, and basically I'm coming out a little bit ahead. I wish I'd sold the whole thing on the announcement, but that's hindsight. But that's not working out given the lack of payment mechanism for the Alzheimer's drug. And the other one is Acadia. They ran into an FDA approval issue where they were blindsided and didn't get a drug approved, and that stock is sold off hard. So those are things I'm doing. I'm trimming losers in my taxable portfolio. I'm going ahead and selling and taking tax losses. In my non-taxable portfolios, I'm trimming my winners, and fundamental stocks that have just not worked out, I'm going ahead and selling those and raising some cash. I think this is a good strategy, and I think that this is something you should take a look at your portfolio. I wouldn't hesitate on that. I'm going to have more to say as far as the Fed and interest rates. I am also going to have a third video coming out in the very near future talking about this whole issue with China, Russia, the U.S. debt cycle, very similar to what Dalio was talking about with the changing world order. He is definitely on to something that's very important there that we need to start taking into consideration, and I'm going to have a more detailed video on that. Once again, this is not investment advice. Please see our full disclaimer on buildingbenjamins.com, and I hope you have a great day and a great weekend. Thank you.